everyone for joining. This is our second part of a series. This one's titled Understanding Adjusted EBITDA, a Simple Guide. Again, we've got Danny O'Loughlin and Nick Stein on the Cetane team that are going to be going through this. We're going to try our best to keep this industry agnostic. So I know there's a lot of folks from some different industries on here, but please, throughout the presentation, ask any questions that you have. This is going to be about 15 or 20 minutes, so we're going to keep it nice and short and sweet. And after that time, we'll try and do our best to facilitate all questions. So thanks again for joining. And Danny and Nick, I'll kick it over to you.
Yeah, thanks, Barrett, and thanks everyone again for joining. I'm Nick Stein.
I'm Danny O'Loughlin.
And we're both directors here at Cetane Associates. And like Barrett mentioned, this is part two, kind of our mini series on EBITDA. In the first webinar, we discussed what EBITDA is, how to calculate it, and why it is important for mergers and acquisitions and financial analysis. But if you missed that one and would like to watch it, we have the QR code there in the middle of the screen, which will take you to that recording. But today we're going to focus on adjusted EBITDA, how it differs from normal EBITDA, the difference between sell side or owner's adjusted EBITDA and buy side EBITDA, and why these different forms of EBITDA exist. So let's dive into the different types of EBITDA. We're going to kind of go through these at a high level, and then we'll walk through examples. So we're going to start with, unadjusted or normal EBITDA. We'll just cover this quickly because, like I said, this is, what we just did a whole other webinar on. But if you're looking at your P&L, this starts with net income and then adds back depreciation, amortization, interest, and taxes. This is obviously unadjusted EBITDA, so it doesn't adjust for any of those large one-time expenses or personal expenses that are not a part of the normal operations of the business, which is, why we're kind of doing this and talking about adjusted EBITDA and different adjustments. So let's dive into sell side or owner adjusted EBITDA from a high level. We know what it is, some of the common adjustments, and then, like I mentioned, we'll go into an example later on. So we're going to start with unadjusted EBITDA, which is why we just covered it. That's kind of the starting point, the building blocks here. Everything kind of builds upon that. And then, when you're looking for different adjustments on, the sell side or owner adjusted EBITDA, we typically look for large one-time expenses or personal expenses that are not a part of the normal operations of the business. And then, beyond that, there can also be seller-specific items, such as related party leases. But you really want to just highlight that this does vary, company by company, owner by owner. And so there isn't like a cookie cutter template here of adjustments, but you really have to comb through the P&L and pick out, what are these, one-time or personal expenses that, when you're doing this, the assumption is that no matter who the buyer is, they wouldn't incur these expenses going forward. So the whole point of this is to kind of normalize that EBITDA and that earnings stream so that, any buyer who would come in and, take over the operations would expect to realize those earnings going forward. And so that's kind of the whole point of the sell side owner adjusted EBITDA. But I will let Danny talk about the buy side and how that differs from sell side.
Yeah, so before we jump into buy side too much, I kind of want to, I guess, set the stage again on, these different types of EBITDA. So you're starting over at unadjusted, which is, I call it, formulaic EBITDA. I know nothing about healthcare, like literally next to nothing. And I could probably calculate formulaic EBITDA for a healthcare company because it's just formulaic. I don't need to know anything about that business. And then what we're doing from there is, that's just formulaic. Then what Nick is trying to do on the sell side is figure out normalized operations. And what that is like, how generally, a normal buyer or like the buyer pool would manage this business. And so Nick presents it to me like that on a normalized basis. And then I, as the buyer, am going to come in and put my buyer specific synergies on that. Or buyer specific, it doesn't have to be a synergy, it could be a negative. But typically these are things that the buyer expects to do with how they run the business, post-closing. These could be, back office expenses, routing, purchasing power. There's a nearly unlimited, but just kind of a reminder, as you start at that formulaic, then Nick's sell side is getting it to like a normalized level for the market. And then I, on the buy side, I'm saying, okay, what does this look like for me when I own it? Um, so hopefully that helps everyone understand, this process and what we're moving through. But, we really want to put numbers to this because that's how, well, I don't know, I learn things. And so we're going to move on to an example here, and Nick is going to present the sell side adjustments and his normalized, and then I'm going to show you how, a buyer would look at that relative to their own special situation. So I'll pass it back to Nick.
Yep. So in this example, I'm going to kind of operate as the owner or the seller here. And there's some general assumptions here. I own a services business that does $8 million in revenue and, $1.5 million in unadjusted EBITDA. I'm still involved as the owner in the day-to-day operations of the business, work roughly 30 hours a week, but want to retire after a potential sale. After, a short transition period, want to, move on, retire, and not work it anymore. I own the real estate in a separate LLC, and the company pays that LLC market rate rent. And I also pay myself a salary through the P&L and am given benefits that are paid by the business. And then the company has less than 50 employees and offers limited benefits, just a simple IRA, and then pays for 40% of the employee-only health premium. So that's kind of the context and the assumptions around, building this case for these adjustments. And so, as I'm going through my P&L, given that context, what can I add back in this kind of sell side owner adjusted EBITDA? So the first thing, would obviously be, my salary and payroll tax, because I am planning to retire after this sale. So therefore a buyer wouldn't have, that salary and payroll running through the P&L once I'm gone. And then the same thing with my health insurance and then, the family cell phone plan. These are all kind of benefits that I am giving myself and running it through the business that once I'm gone, a buyer wouldn't expect to have these expenses going forward. And then moving on to travel, meals, and entertainment. Again, these are those like personal expenses or one-time expenses that I'm talking about. And that, whether it's just like vacations that I'm running through the business, meals, entertainment, whatever it is. These are all kind of like personal expenses that I ran through the business and I didn't use for business purposes. And that's why I'm adding back that $12,000. And then, like I mentioned, I do own the building, the real estate in a separate LLC, but I am running all office repairs and maintenance, enhancements, upgrades to that building, through the P&L of the business. And so given that I own the real estate, a buyer would just be paying rent and they wouldn't have to, incur those expenses of actually upkeeping the building going forward. So we're adding back those repairs and maintenance. And so, once you add up all of those different adjustments, you get your total adjustments, and then you add that to the unadjusted EBITDA. And that's how we get that sell side adjusted EBITDA, 1,922,000. And so you can see why, whether you're planning or you're actually looking to exit, why it does, it does matter a lot going through and doing these adjustments, because if you just added $422,000, of potential EBITDA here. And so that's, it's really important to, kind of go through the P&L, pull out the things that, have a really good case of being, personal or one-time expenses that are not a part of, the normal operations of the business, and then create, like we said, this more normalized earnings stream that, a buyer would expect to receive in the future and, therefore is willing to pay off of. And so that's kind of the whole sell side, approach. And then we'll move on to the buy side and kind of build upon this and see what the differences are and how they view it versus how, a seller or an owner would view the adjustments.
Yeah, so as Nick said, he went and pulled himself out of that business with his sell side adjustments and his sweet 350K year salary. And so what he's done is normalized it for the market, and that's what your broker will do. And then I am going to act as the buyer in this scenario, and whether that be strategic private equity, your neighbor who's rich, they should all take a look at it in this manner. What does this look like to me? And so I've got Nick's sell side adjusted EBITDA number, and I'm going to go here and work through, what does this look like for me? And so because it's what does this look like for me, I need to lay out some assumptions of what my business is. So I have national accounts or business insurance. Let's just pretend I'm huge. I'm doing 50 to 100 mil in rev. I have way more than 50 employees, but when we combine them all, I'm going to have a couple thousand. I do not have local operations in wherever company ABC is located. But I do, as is common with larger strategics, have a centralized admin, legal, accounting, and call center function at my home office. Um, so what we kind of want to go through here is, once again, what does this look like to me? So Nick has given me, all right, this is normal. Like this is what the normal operations of the business. So then I go, okay, well, Nick, I have a relation with ABC supplier. So I get a purchasing synergy of 100 grand. I just get better prices on materials. However, I don't have local operations. So Nick was working 30 hours a week. I probably can't just, I mean, maybe I could promo someone into this role, regardless of how that looks, I'm going to need some format of GM. And even if I promo someone in, I got to slot someone in behind them. So regardless, we're going to take a negative adjustment here in that I need a GM. Am I going to pay them $350,000 like Nick? No, he was paying himself a little bit rich. The fair value of this role in this market is 120. So I've reversed that out. The buyer case is not always better. It's just more specific to the buyer. However, coming on with the buyer case is not always better. Um, in converting that to better, I have big back office synergies because I've got this, call center and all this admin and I run blank system and blah, blah, blah. So to, take a synergy there. Legal and accounting, my corporate legal and accounting team can absorb this with no material increase to wages, therefore savings there. You might have been outsourcing it to someone, Nick. Business insurance, sometimes this doesn't end up being positive because car insurance is a brutal thing. But yeah, business insurance, I've got national accounts. I spend $5 million a year on insurance. I'm getting a better rate. However, what's interesting, and this is really common, and I think people need to watch out for it, and there's ways around it that have questionable legality. But once you hit that 50 employees mark, you've got to provide health insurance. And then typically that's a full benefit package. And so I'm bringing these employees who have only simple IRA into my big company that has health, vision and dental. I need to, well, I'm not going to get into the calculations because they're horrifically boring, but they would essentially take some format of benefits and that would cost me some money. And so, at the end of this, we've moved from, unadjusted. Nick's presented it like, okay, this is what the market, generally people should think about the earnings stream. This is normal. And then I've said, okay, this is what I can get out of this. And that's really what that buy-side synergized EBITDA is. Yeah, I don't think I missed anything. I think that's pretty much it.
Yeah, just real quick. I know we had an initial question on this, so I just wanted to cover it real quickly. So I know I talked about on the sell side, my adding back my compensation and payroll tax, but what about other, potential family members who work in the business? How do you approach that? Is that always considered adjustment? Is it never considered adjustment? How does that work? And so that, like most of the adjustments, it really is kind of a case by case basis. So it just depends on what that family member is doing in the business, whether they are wanting to stay on post close or whether, they're wanting to move on. Obviously if they're, director of operations, like that's probably not a role that you can, remove without, like Danny said, having some sort of backfill or reversal of that add back. So you probably can't take an add back on a role like that. But, if there's someone doing payroll or accounting, that's kind of a function and they, that person wants to, retire or leave, after the sale, then that is kind of a role that is more likely to be taken as an adjustment because most buyers would be able to kind of absorb those functions post close. So that was just a quick, question that came up that I wanted to touch on. As like I mentioned, a lot of these sell side adjustments, they do vary by company. And there's, like I said, there isn't like a cookie cutter template. You can't just kind of copy the ones we have here. You really have to analyze it and look at, every one individually. But that was a good question that I wanted to cover real quickly.
Excellent. Yeah, I think that's a great point, Nick. So at this point, I think we'll start to jump into Q&A. We do have a few questions already that were sent in. And then if you have some more, please use the Q&A or chat function down below, and I'll try and get to them. If you have to slip away, please do so, and we will have a recording of this, hopefully up in the next couple of days. And then just wanted to mention to everyone, if you've got questions about your specific business or your specific EBITDA, don't hesitate to reach out to anyone on the CTAIN team. and we'd be more than happy to help you. So the first one we've got here, I think you guys have really hit on this well. Nick, you kind of closed with it, and it's not just this question, but it's a lot of it is case by case. But does the owner's compensation always get 100% added back into calculating the adjusted EBITDA? I think you guys have nailed that on the head of it's really a case by case. What's the owner doing? What is the buyer situation? Anything else you want to highlight there? You feel like we've knocked that one out?
Yeah, I mean, the only thing I would highlight there is if you're working over 40 hours a week, you're as your hours go up, your percent chance of being an add back goes down.
Yep. The inverse relationship of
Yeah.
time and money. So I like this one actually because it does come up quite a bit. I don't take a salary from my business, but take distributions as a shareholder. Are those added back to EBITDA?
And I think
Yeah,
this
go
one,
for it.
I love this question. Thank you so much for asking. All these add backs take place. I love accounting. All these add backs take place on the income statement. And so the thing is, those are post-tax distributions coming out of equity. Um, that's post net income. You close net income to equity, and they're pulling it out. These EBITDA is just a income statement calculation. So that's already like post-tax, whatever. You can dump that, but it's not a part of EBITDA. Never is it going to be a part of EBITDA. If it hits your P&L, it could maybe be a part of EBITDA or probably is, but if it's coming straight out of equity, just see where that account's hitting on your QuickBooks.
Yeah, just to add to that, I mean, beyond distributions, just across the board, you can only have an add back if that expense is being run through the P&L. So no matter what that expense is that you're looking to potentially add back, whether it's distributions or something else, it has to be run through the P&L in order to qualify as an add back and hit your EBITDA.
Mm-hmm.
Yeah, it's a great point. I think we've touched on this, but I think this is a good one to hit on again. Should savings from potential optimizations that haven't been done from a sell side, in your example, Nick, be factored into adjusted EBITDA? Like I'm thinking changing a credit card process, or maybe business insurance is astronomically high, and you can look at that.
You mean changes from a potential buyer coming in changing it, or changes in like it's the owner made changes in the last year or something?
Let's start with the latter because I think that's an interesting case point. Is it worthwhile in that case adjusting historical years, knowing that there has been a change put in place?
I would say if you can prove out the savings and that it's, working in kind of the go forward earnings stream, I think that's kind of the whole point of adjusting is to find a normalized, go forward earnings stream. And so I think that is fair to, if you can back up those savings, I think is the main thing. You can't just kind of put like an estimate on it, like, oh, I think we saved 50K in the last year making this change. But if you have actual kind of proof of those savings, then I think that is a valid adjustment to the historical period.
Great. I like this one, and then we've got another tangent off of it. But how typical would you say is it for a buyer to share their EBITDA with the seller?
Oh man. So first things first, anchored multiple deals are horrible because all you do is fight about EBITDA. And that's where you both share your EBITDA, and then you are like, I'll buy this at 9x. You agree to the 9x, but you don't agree to the EBITDA. You never want to do that. It's horrible. But buyer will sometimes show seller EBITDA, a lot of the time, except when it gets really high, because then they think, that the seller might come back to them. I've seen it shared a lot with the sell side when going through financial diligence, just because they're going to see it as you're going through it. Anyways, I know that some buyers don't love showing their EBITDA look though when it's too high, because then they think that the sell side's going to retrade them. So there's no right answer to that.
Yeah, I mean, we've done quite a few of these at CTAIN, and it's very, very rare that we actually see that number from the buyer presented to us. I've got a question here, and what is current multiple on the EBITDA, and is it based on seller or buyer? And I think this one, we've got quite a few industries here, so they vary when we're talking EBITDA. But one thing that I like thinking of is, simple math. if I have $1 million straight EBITDA, a $2 million adjusted EBITDA, and then a 3 million, I guess let's say 3.3 million of buyer synergized EBITDA, the purchase price is still 10 million. And so you can divide into what the multiple is. From that standpoint, the buyer multiple is lower because they're using 3.3 as their synergized number. The adjusted EBITDA of 2 would be a little higher, and then a straight EBITDA of 1 would be the highest multiple, in that case, 10 times. So it really, I guess, Danny, Nick, any color to add to that?
Yeah, I mean, I have a pretty strong opinion about this. I think when we are discussing, where the market's currently at, we're almost always citing off of a sell side EBITDA multiple amount. Because I
Yeah.
don't, like you said, I don't know what the buyers are even getting on their stuff anymore. And it's a case by case basis. I'm not going to call them, hey, what's your multiple? So yeah, I think it's pretty much always quoted off sell side though.
Okay, great. I like this one. Is there a standard for what qualifies a valid adjustment, or is it just a matter of what you can support? And Danny, Nick, I think it'd be great to talk a little bit about a quality of earnings with this one as well, and how that looks.
Yeah, I think the in order for it to be a valid adjustment, you have to be able to support it. And I think that's the whole point of why buyers do quality of earnings, is that they dig into those adjustments and they ask for that proof or that support. And then they, confirm it on their end as well. So I think in order for it, yeah, like I said, in order for it to be a valid, add back, he has to kind of stand up to scrutinization of a quality of earnings. And so there needs to be some level of support. You don't need the most insane detail, logging every single little thing, but there needs to be some level of support there supporting those adjustments.
Yeah, to Nick's point, you better bring the receipts because someone's going to go digging. But also off of that, what makes it valid, what makes it a move towards normalized operations. Sometimes sellers or sometimes buyers are going to throw out valid assumption or valid adjustments anyways. I think the validity comes from and this is why, I said at the beginning of the webinar, I could calc a formulaic medtech company EBITDA, but I would have no idea how to do their sell side because I don't know what normal operations look like. And so I think that's where sales point, that's where, we really come in and help, is that we understand what the buyers are looking at, what normal operations is for a company of blank size. And so that's, where we create our value in this equation, is we understand what a valid adjustment is.
Great. Danny, I think you'll like this one. So, looking at deals made within my industry, some are straight cash deals and others have upfront payments with a deferred 2-3 year quarterly payments being made as a percent of sales in this example. If you're the buyer, how should you represent these quarterly payments on your P&L? Should they be P&L or balance sheet?
Good God, that is gritty. On your balance sheet, quarterly payments. No, I think you'd have to account for the entire merger first and fair value the the at-risk portion, and you'd put that up. Then you'd account for the cash going out the door, and then you'd capitalize it somewhere on the back end. I will say we try to avoid earn-out deals if possible.
Yeah, I think, correct me if I'm wrong here, but if there's a component of the purchase price allocation that's non-compete, you can't expense that fully on the P&L.
Are you talking like amortizing non-competes?
No, like let's say I'm just paying 500 grand over 5 years, 100,000 a year. You can, as a buyer, fully expense that as an expense.
Yeah, my CPA license is pretty stale. I really don't know the answer to that. Sure. I mean, it doesn't really matter because let's just be honest for 2 seconds. That's all GAAP and financial reporting earnings, and nobody cares about that. From a cash perspective or from a tax perspective, it's all based on cash, and so it's not going to impact your taxation at all. So you can just, you're playing, financial reporting games at that point.
Yeah. I like this one. What about a business that has a decent EBITDA, but with some capital from a buyer could be significantly enhanced? Where does the buyer put capital improvements in their forecasting of future EBITDA?
I mean, depends on how you run your business. Let's assume you got investment committee or board of directors. You're going to throw it in your future projections. Also, the fun fact about a lot of that cap improvement is going to be expense via depreciation. And so a lot of it's not even going to matter for EBITDA purposes.
I think what he's trying to get to is like that wouldn't be layered usually into the buy side adjusted EBITDA because those are more future cash flows that are expected. So that's more into their forecast and kind of supporting their investment thesis, but it wouldn't be baked into the historical adjusted EBITDA.
Yeah, to go one step further on what Nick's saying, every responsible buyer is running a discounted cash flow analysis too, and then discounting it back at their cost of capital. And so they're also going to have that analysis, and that's where that's going to live.
Yep. Totally agree. I like this one. A caveat to an earlier point, Danny, why do you like to avoid earnouts?
Oh man, because nobody wins besides lawyers. So CFOs hate it because, like, let's say it's based on customer retention, or like then your GM hates it because they have to track it. Your CFO hates accounting for it. They don't like having this big question mark of do I owe this person $1 million or not on the P&L. And then it's always a great time to fight and litigate on the back end. They're like, oh, you changed my business. Yeah, that's why I didn't get my revenue, blah, blah, whatever the reason may be. People just love a good lawsuit at that tail end of an earnout. And so I just prefer to avoid unless they're like easily, I'm not going to go down that path. Avoid.
Yep. So, I think we're getting close to about 30 minutes and don't want to take too much more time. We've had a few questions through here about specific industry stuff and specific multiples. Again, if you just want to reach out to us directly, we'd be happy to kind of talk through your industry or your business. We do a free value range analysis if that's something that you'd be interested, that we can kind of look at what your business is doing and then how we can enhance stuff in the future, for if there's a sale or if you're looking to buy. I think there's a lot of things that can be helpful for. A closeout that I just think is a pretty funny one here. Any fun stories, let's say, of the most unusual adjustments that you've seen from your time looking at businesses, Danny and Nick?
You have a good one.
I have a good one. I have a good one. Yeah, there was a line item and it said boat McLaren pool. Fun fact, you should not have that as a line item because right when the IRS pops your books, that's what they're going to notice.
So we're not the IRS.
But I'm not the IRS. I really
care.
don't care. I just laughed about it. But yeah, that was a whole interesting. I mean, obviously that's an add back. I mean, I personally wanted the McLaren. I've had to add back private jets, and I'm like, well, what? I want the jet. Come on, guys. Yeah, yeah. So there's a lot of them. There's some interesting stories out there. People run some crazy stuff through their businesses.
One that's coming to mind for me was a pretty big one, and the expense line was big oil. And this was for a oil and propane business, and thought, okay, what's big oil? Could be something legit. And we did a little digging, and it actually was the fishing boat that was used for the tournament entries, and I believe the gas. And we've seen a lot under the sun. I think there's a few other funny stories that we'd love to tell you guys over drink sometime next time we see you.
Yeah, there's some winners out there.
So, well, thanks again, everyone, for joining. If you have any questions, Danny and Nick are always a phone call or email away. You can reach out to any others on the CTAIN team. We really appreciate everyone joining and taking some time this afternoon, and look forward to seeing everyone around. Thanks so much.
Thanks, everyone.
That's all.